Welcome back. We are watching a coronavirus-related sell-off this morning. Disease fears plunging global markets across the world this morning, with the Dow set to open down 820 points. Plus, European markets are even hit harder, all down better than 3%. Take a look with the FT 100 down almost 300, the CAC 40 down 225, and the DAX index in Germany down 505 points right now, almost 4% there. Asian markets down as well. There are new cases of coronavirus this morning reported in South Korea. Joining us right now is Baltic Capital Markets Head of Global Research, Kathryn Rooney Vera. Kathryn, always good to see you. Thanks very much for being here this morning. On a busy morning, obviously. When you wake up to see a market down 800, what's your first move?
Look, it could have further to run, right? SARS in 2002, 2003 took the market down 25%, Maria. Of course, there was that V-shaped sharp rebound thereafter when the market rebounded more than 25% in only 2 months. The market hasn't even considered it yet. And I think what's going on right now, Maria, is that the extent of the now what we're calling pandemic, the duration of it is much longer than the market would have previously hoped. So the market is beginning to price in what, in my view, will turn out to be a severe contraction, temporary in nature, for the Chinese economy, with some direct impact on global growth.
So do you want to just avoid those companies and sectors that are going to be hit hardest here? Or are there areas to hide here, or do you just want to shut down and not do anything right here? I mean, what I've been saying in the last several weeks is you take the first quarter out completely out of China because there's no economic activity. How does that hit the U.S. probably coming up in the third quarter as these supply shortages really impact earnings? So do you want to avoid things like an Apple, which is producing everything out of China? Or are there areas, do you think, that there are places to hide as well?
You're going to want to buy those areas, right? Because at some point, you're going to see a V-shaped sharp recovery. This is not something that's going to take down both the Chinese economy, the U.S. economy, and the global economy. Important to remember as well, and I've said this as well when we had the tariff wars, is that in terms of trade, now you're talking about earnings and you're talking about corporate earnings and the like, and I understand that. But when we're talking about U.S. economic growth, the percentage of the U.S. economy that's tied to exports to China is less than 1%. So there's not a direct impact on the U.S. economy. In terms of earnings, you could see a slowdown, but you'll eventually then get a sharp V-shaped recovery. What I like is when you get that nice-sized correction, Maria. We're not talking 3-5%. We're talking, 15%, a combination of Sanders, a combination of coronavirus, a combination of what Dagan previously mentioned, which was this big bond bubble that's currently in the works. Then you start to step in. And where you step in, Maria, is in Chinese consumer discretionary, Chinese transportation, and U.S. equities.
Hello, I'm John Lonsky, Moody's Analytics. One thing we should be keeping an eye on to try to judge how this is affecting the world economy is what's going on with industrial commodity prices. They're down, they're off a bit for the year to date, but they're still well above their lows of 2015, 2016. Again, things could get worse. And I would also add, too, take a look at Chinese economic growth, now expected to come in at 5.4% this year. That's the lowest since 1990. But China was a much smaller player in the world economy in 1990 compared to today.
Kathryn just mentioned something, though, I want to touch on. Is part of this, it's hard to quantify, is part of this sell-off related to Bernie Sanders now being the front runner?
That was my thought, too. I'd love to hear what Kathryn has to say about that.
That's also part of it, for sure. Yeah. What do you think, Kathryn?
Look, I think you need to protect your positions both against the coronavirus risk, the bond bubble, and the Sanders. And the way that I'm recommending this for this to clients in a market that has elevated levels of complacency is not liquidating your positions, but protecting them with put options. The put option that I recommended back in the end of last year was for March 31st expiry. I'm holding that. I'm telling my clients, be aware of the Bernie Sanders risk. It will take down the markets. We're talking about force and coercion. We're talking about socialism, which the market really hasn't even priced in. Technology, which is 25% of the S&P 500, will come under pressure.
Yeah.
Energy, tech, and banks.
I mean, actually, when you see, Bernie Sanders do well, usually the market goes up because there's a wide expectation that he's not going to be able to beat Donald Trump and Trump's policies stay intact. Do you think this is more, do you think this is also about that, about Bernie Sanders moving higher in the rankings?
Well, it has to be part of it. It's, as Dagan said, it's hard to quantify, but the truth is the market is taking for granted the risk of a Sanders, possibility. And once the market starts to price in even the remote possibility, of a win November 3rd, then you will get risk off. So I think there's an expiration date on complacency. If Sanders, Maria, if Sanders wins big March 3rd and volatility remains as low as it has been, then I'll be extending the expiration date on those put options for November 20 of 2020. Currently, Maria, it will cost you less than 5% of your return to protect your positions from now through November.
Well, look, you've got a lot of unknowns out there, right? You've got the unknown of the coronavirus, the unknown of the election, and, of course, valuations at pretty outsized levels there as well. So not a great recipe if you're long this market. Kathryn, good to see you this morning. Kathryn Rooney Vera joining us there. Stay with us. We'll be right back.